What's up, penny boys and gals? It's your boy, What the Duck here, and it's time for another trading class video. If you aren't already a part of our premium Discord, or even our free Discord, well then make sure to check us out at discord.gg/btpenny. We give out free alerts to our free Discord members, like this huge 700% profit that's on the screen. But the premium Discord is where all the alerts are, be it options, day trades, swing trades, or even long plays. We also do have cash giveaways. Our next one is going to be a $100 giveaway this Monday, and it's not too late to get in on the raffle. So if you're already a premium member, go check out our raffle channel to enter, and if you're not, well then check out our Discord so that you can join and get in on the prizes. Alright, so we already went over different indicators that show support and resistance, as well as indicators that can show if a stock is oversold or overbought. And that was in our premium Discord live stream area. I'll be uploading those videos to YouTube soon, but if you want to be getting in on those as they happen, well then make sure that you join our Discord and join Penny Boys University, which is free for premium members. Last night, in the YouTube live stream, we went over VWAP as well as the MACD. So if you haven't already, then make sure that you check that out, and that's going to be in this channel. Tonight, we will be going over moving averages. So I'm sure a lot of you already use moving averages during your trading, so this might just be a refresher for some of you. But for those of you who don't know what moving averages are, or how they work, well, the first thing that you will need to know is that there are two types of main moving averages, the SMA and the EMA. The SMA is known as the simple moving average, and the EMA is known as the exponential moving average. The one on the screen right now is the SMA, the simple moving average. So first of all, what is a moving average? And what are they used for? So, moving averages are used to identify trends and confirm reversals. So what I mean by identify trends means figuring out if a stock is trending up or trending down. When I say confirm reversals, this means trying to figure out if a stock that is currently trending up is about to start trending down or reverse, or of course vice versa. What most moving averages tell us is that the average price of a stock over a certain period of time. So most moving averages tell us what the average price of a stock is during a certain period of time. Just like other indicators, this is figured out by mathematical equations. The moving average takes the sum of the closing price over a certain period and divides it by the number of periods. So if you're looking at the 10-day moving average, it'll take the sum of the closing price over the past 10 days and divide it by 10. So now that you know that, you can now see how the moving averages are based off of past prices, which is why it can't warn you of anything in advance, but instead it can help confirm if a trend or reversal is taking place. Typically speaking, if the price is above the moving average line, then there's an uptrend happening. When the price is below the moving average line, then there is a downtrend happening. When the price breaks above or below the moving average line, this is known as a trend reversal, which means that the current trend might be starting to reverse. So in simpler terms, if the price crosses over the moving average line, it might be a good time to buy, and if the price crosses below the moving average line, it might be a good time to sell. The close of the candlestick is the price used to determine the moving averages. So that means that the price that the stock ended up at during a certain period of time, be it 1 minute, 5 minutes, 1 day, or whatever chart that you're looking at, that's what's going to be used to determine the moving average. Also, the close of the candlestick is also what determines if a price has broken the support or resistance. The longer the time factored in, the stronger the support or resistance. So for example, the 200-day moving average is a stronger support than the 20-day moving average, and the 20-day moving average is a stronger support than the 10-day moving average. Also, the longer time period the moving average holds as support, the more significant it is when it is broken. So if the 200-day moving average was used as a support and held as support for only 1 day and then it gets broken, that's not as significant as it would be if that 200-day moving average was used and held as a support for a month and then was broken. So if the price is moving above the moving average is the support. And if the price is below the moving average, then the moving average is the resistance. And once the support is broken, then it becomes the resistance. The more people that use a certain moving average, the more often it will act as a support or resistance. This is called a self-fulfilling prophecy. So if, let's just say, 95 out of 100 traders, and I know there are much more than 100 traders out there, but this is just an example. So if 95 out of 100 traders are all looking at the 50-day moving average as a support, well then chances are the 50-day moving average will act as a support. But if only 5 out of 100 traders are using the 50-day moving average as a support, well then it might not be used as a support. It might not actually act as a support. Okay, so what's the difference between the SMA and the EMA? And I'm going to actually post a picture of what the EMA now looks like. So this is the SMA, this is the EMA. So you can see how the lines are a little bit farther away on the SMA and closer together on the EMA. Okay, so what's the difference between the SMA and the EMA? Well, the SMA, or simple moving average, shows long-term trends. It has more lag than the EMA, which makes it slower to react to price changes than the EMA is. Whereas the EMA, or exponential moving average, which is the one shown on the screen right now, is typically used to show short-term trends. It responds faster to price action and responds quicker to shifts in sentiment, aka supply and demand, news events, etc. It has a little bit of a different calculation than the SMA, which is why it is quicker to respond and typically makes it closer to the current price than the SMA. So, some commonly used time periods or settings for the SMA is either 10 to 20 as your short-term trend, 50 for your mid-term trend, and 180 to 200 for your long-term trend. So as you can see on this one, I am using the MA10, the MA50, and the MA180. So I'm using the 10, the 50, and the 180, but typically people will use anywhere between 10 to 20, and then 50, and then 180 to 200. And the EMA is really based off of a trader's preference. These are usually smaller numbers, anywhere between 1 to 10, or 1 to 20, or sometimes even 1 to 50. As you can see, I'm using 5, 10, and 20 on this chart. But this is all based off of personal preference. So when do you use the SMA versus the EMA? Well, the EMA is used for short time frames, or a fast-moving stock, and the SMA can be used for long-term holds, or to filter out the noise and determine overall market direction. Some traders will buy when the price touches or goes above the moving average and set a sell limit right below it. Some traders will also buy when a shorter moving average, example the 10-day moving average, crosses above a longer moving average, for example a 20-day moving average. Or they'll sell when a shorter moving average crosses below the longer moving average. Some traders use Fibonacci numbers, which is, for instance, 5, 8, 13, 21, etc., to select their moving average, typically their EMA, their exponential moving average. But the numbers that you use are always up to you, and it takes trial and error to see what works best for you as a trader. Not everyone is the same. Just like in baseball, a heavy bat might work for one hitter, but not the other. A lacrosse stick might be best for one player, but not the other, and so on and so forth. Everyone's different. Like a glove might work for one player, not the other. It's important to know that moving averages are backwards looking by nature. While EMAs can reduce the lag effect on developing trends, they still rely on past data that can never be applied to the future with complete confidence. And you can't use moving averages only to be a great trader. It's not the only tool that you would want to be using in order to be a great trader. You need to learn how to mix and match them with other indicators such as RSI and MACD, which we did go over in our previous videos and in our previous live streams in the Penny Boys University Discord. So if you want to know how that works, then check out my past videos and join us at discord.gg/btpenny to get in on all the other indicator classes. This is why so many traders start out paper trading, so that they can see what works best for them, without going broke in the process. The stock market is like anything in life. It takes practice to get good at. That's why lawyers start out with mock cases and then smaller cases, and doctors start out with mock procedures and then move on to small procedures before going into a really big complicated procedure. Traders start out with paper trading and then slowly put in small amounts of money into the market before they get confident over sometimes months or years' time, and then eventually start putting in some real money. Okay, so I'll be answering questions in the Penny Boys University area in our premium Discord. So make sure that you check us out at discord.gg/btpenny. And if you want to figure out how to set your moving averages in the Webull app, check out my Webull overview video in this channel, this YouTube channel. I'll also be making a setting indicators on Webull video very soon. So make sure that you subscribe to my channel so that you can be notified whenever there is a new video. And don't forget to hit that like button, and please comment which moving average setting that you like to use the best, if you do use moving averages. I'd love to see them all, and we can compare and contrast what moving averages we all use. Also, don't forget to follow me on Twitter, Instagram, Facebook, StockTwits, and Webull. You can search me by just looking up WTD Penny Boys on any of those platforms. That's Twitter, Instagram, Facebook, StockTwits, and Webull. It's WTD Penny Boys that you can look up in order to give me a follow. I'll be posting a bunch of stuff on the Twitter and Instagram especially. I'll be posting different tips and tricks, some certain plays, maybe some freebies as well. So it's definitely worth giving me a follow on those. All right, I hope that was helpful. I hope that you were able to learn a little bit, get some knowledge dropped into your brain. And if you aren't already, check us out at discord.gg/btpenny so that you could be like Jacob Lau, who has joined us almost a little bit less than a month ago. He actually joined us through these trading classes, and then he liked them so much, he's like, you know what? I want to get in on those alerts. Like that 700% profit call that I put on the screen earlier. That was huge. I know Tesla, we made over 1,000% in profit on Tesla, among so many other good plays as well. So definitely check us out at discord.gg/btpenny, and check out our Facebook at facebook.com/groups/btpenny so you can get in on the action. All right, once again, I will be in the Penny Boys University chat, the PBU chat, to be answering some questions. So check us out there, and I will see you guys all there, and hopefully you will join me, What the Duck, in our premium Discord so that you and I can make some bread.